Okay, so get this. No Berkshire Hathaway stock buybacks this quarter. First time since 2018. It makes you wonder what's going on in Warren Buffett's head, right?
Yeah.
Luckily, we've got his latest 13F filing to peek into his portfolio moves. It's like spying on the homework of the smartest kid in class, hoping some of that brilliance rubs off.
It is fascinating to see how Buffett is shifting his capital around. This 13F filing, for those who might not know, is essentially a quarterly report that reveals what big investment firms like Berkshire are holding.
Right.
It doesn't tell us everything, of course, but it offers a glimpse into their strategy.
And this time that glimpse includes some real head-scratchers. Like Domino's Pizza.
Domino's.
Buffett bought 1.28 million shares, worth about $550 million. Is he suddenly hosting pizza parties every weekend or what? This doesn't seem like his usual play.
Well, what's interesting here is that this move could signal a broader trend that we're seeing with some of the most successful investors. They're recognizing the resilience of strong consumer brands, even in the face of economic uncertainty.
So even if a recession hits, people aren't giving up their pepperoni.
Exactly. Domino's has a massive global presence, and they've adapted well to changing consumer habits with online ordering and delivery. This makes them a potentially stable bet in volatile times.
But wouldn't that apply to lots of companies? Why Domino's specifically?
That's the million-dollar question. It's possible Buffett sees something unique in their business model, their management team, or their long-term growth potential. Perhaps he believes they're undervalued by the market. Or maybe he just really loves pizza.
Okay, fair enough.
Yeah.
But then there's Pool Corp, another new addition to the portfolio. Are we all supposed to install pools now?
Well, Pool Corp is the largest distributor of pool supplies and equipment.
Right.
And their inclusion could be tied to the continued strength of the home improvement market. People have been investing heavily in their homes, and that trend doesn't seem to be slowing down.
So maybe Buffett's thinking even if the economy dips, people still need to maintain their pools. It's a bit of a niche market, though.
True, but it's a market with consistent demand. And remember, Buffett has always been a fan of businesses with a wide moat, a competitive advantage that protects their profits. Pool Corp certainly dominates its space.
Okay, I'm starting to see the logic here. It's less about pools themselves and more about tapping into a steady, less glamorous market that others might overlook.
Yeah.
Kind of like his increased stake in HEICO, the aircraft parts maker.
Precisely. He started that position last quarter and added to it this time. Essential, but not flashy.
Right.
But speaking of contrast, let's move to the other side of the equation, what Buffett's selling.
Okay.
And this is where things get really interesting.
Because he's trimming Apple again. That's been making headlines. This quarter's down another 25%, leaving him with 300 million shares worth almost $70 billion.
Right.
But earlier this year, he said Apple was a long-term hold.
He also said he wasn't afraid to trim as the stock price went up, and Apple has had a major run-up lately. Lots of optimism around their new AI products.
So is he just taking profits off the table, as they say?
For those unfamiliar with the term, it means selling some of a stock that's gone up in value to lock in those gains.
Oh, okay.
And yes, that could be part of it. But we also have to consider whether Buffett sees something changing in Apple's future. Is the AI boost sustainable? Is the market overvaluing them?
It's not like he's dumping all his Apple stock. It's still his biggest holding by far. But he also reduced his stakes in a bunch of other companies. Bank of America, SiriusXM, Capital One, Duo Holdings, Charter Communications, even Ulta Beauty. That one was down a whopping 96%.
Wow.
Did he get a bad haircut there or something?
It's unlikely that personal experience is driving his investment decisions.
Yeah.
More probable are concerns about the sectors these companies represent. The financial sector, for instance, is facing headwinds with rising interest rates, potentially impacting banks like Bank of America and Capital One.
And maybe Ulta Beauty, despite being a recent buy, isn't performing as well as Buffett initially thought.
That's possible. It highlights an important reminder: even Warren Buffett doesn't bat 1,000. He makes adjustments as needed, which should be a lesson to us all. But speaking of investments, there are two companies he completely exited this quarter.
Oh, yeah. Liberty, SiriusXM, and Floor & Decor. Completely gone. What happened there?
Complete exits are always intriguing. It suggests Buffett and his team see a significant shift in those companies' long-term prospects to the point where they're no longer worth holding. It begs the question, what changes is he anticipating, and are they reflected elsewhere in his portfolio? It's like he's playing a giant game of chess, moving his pieces around the board based on a strategy we can only partially see.
But maybe we can get a few steps ahead by analyzing those moves right.
Yeah.
If we look at what he's holding on to, those top 5 companies still make up about 70% of the portfolio. Apple, American Express, Bank of America, Coca-Cola, Chevron giants, every one of them.
And that's a hallmark of Buffett's approach, investing in companies with strong fundamentals, a wide moat, and a history of weathering economic storms. He's not chasing the latest fad, he's building a fortress.
So he's taking profits off the table with Apple, but not abandoning ship. He's betting on consumer staples with Domino's, but also dipping a toe into the home improvement trend with Corp. It's like he's hedging his bets, preparing for multiple scenarios.
Exactly. And let's not forget that while we're focused on the stock portfolio, Berkshire Hathaway is much more than that. They have a vast array of wholly owned businesses, from insurance to railroads to energy. The 13F only shows us a sliver of the pie.
It's like trying to judge a chef's skills based solely on their appetizer. We need to consider the whole menu, the entire investment philosophy, to really understand Buffett's game.
And one element of that philosophy has always been his willingness to buy back Berkshire's own stock when he believes it's undervalued. Remember, he's only doing this when he has excess cash. A&D thinks the shares are a bargain.
Which is why it's so intriguing that he didn't buy back ANY shares this quarter. Earlier this year, he spent $2.9 billion on buybacks, but now nothing. What changed?
It could be that he simply sees better opportunities to deploy that capital elsewhere. Maybe there's an acquisition in the works, a private business he finds attractive, or even real estate deals that offer a better return than buying back stock.
So the lack of buybacks doesn't necessarily mean he's bearish on Berkshire itself, just that he sees better value plays elsewhere.
Precisely. It all comes back to his core principle of allocating capital where it will generate the best long-term returns. And that requires constant evaluation adjustment and a willingness to shift course when necessary.
Which is a lesson we could all learn from, right? You get attached to our investments, but sometimes the best move is to sell, even if it's something we thought we'd hold forever.
Absolutely. Buffett is famous for saying, the stock market is a device for transferring money from the impatient to the patient. He's willing to be patient, to wait for the right opportunity, and to act decisively when it arises.
But for those of us who aren't multi-billion-dollar investors, how do we apply these lessons? It's easy to say, be patient, allocate capital wisely, but what does that look like in practice?
It starts with understanding your own investment goals and risk tolerance. Are you investing for retirement, for a down payment, or for something else? How much volatility can you stomach? Once you have a clear sense of your objectives, you can start to build a portfolio that aligns with them.
And that's where research and due diligence come in, right? We can't just blindly follow Buffett's moves. What works for him might not work for someone with a different financial situation or time horizon.
Exactly. It's important to remember that investing is not a one-size-fits-all endeavor. What matters is finding the right investments for you based on your individual circumstances and goals. But that doesn't mean we can't learn from the masters.
So what are some key takeaways from this deep dive into Buffett's portfolio that our listeners can apply to their own investment journeys?
Firstly, don't underestimate the power of long-term thinking. Buffett is a master of this. He's not interested in short-term gains. He's looking for companies that will compound in value over decades.
Which means finding companies with strong fundamentals, a solid track record, and a durable competitive advantage.
Precisely. And secondly, don't be afraid to adjust your portfolio as conditions change. Even Buffett, with his reputation for buy and hold investing, is constantly tweaking his holdings based on his evolving assessment of the market and individual companies.
So flexibility is key. And finally, always remember that investing is about allocating capital where it will generate the best returns. That could mean stocks, bonds, real estate, or even starting your own business.
It's about finding the right mix for you and having the discipline to stick to your strategy.
All great advice.
Yeah.
Before we wrap up, there's one question that's been nagging at me. We've talked about Buffett's moves, his philosophy, but what does it all mean? What's his overall outlook on the market, and what clues are hidden in this 13F filing?
That's the million-dollar question, isn't it? And unfortunately, we don't have a direct line to the Oracle of Omaha's thoughts, but I think we can glean some insights from his actions.
Okay, I'm all ears. Decode this way. What's the hidden message in these buys and sells?
Well, if you look at the overall picture, there's a sense of cautious optimism, I'd say. He's not running for the hills. He's still invested. But he's also being selective, taking profits where valuations are high and seeking out companies he believes are undervalued.
Like Domino's and Corp. Safe havens in a potential storm.
Yeah, they could be part of that strategy. Remember, these are businesses with a strong consumer base, essential products or services, and a proven ability to adapt. That suggests he's preparing for a range of economic scenarios, not just betting on a boom.
And what about those Apple sales? Is he losing faith in the tech giant?
I wouldn't say losing faith necessarily. Remember, Apple is still his largest holding by far. It's more likely he's rebalancing his portfolio, taking some chips off the table after significant run-up in the stock price.
The intrinsic value thing again. He thinks Apple's price is getting ahead of itself even with all the AI hype.
Exactly. Intrinsic value, to put it simply, is what Buffett believes a company is truly worth based on its assets, earnings, and future potential. He's a value investor at heart, always looking for bargains.
So he's selling some Apple now because he thinks it's a bit overpriced. But he's holding on to a big chunk because he still believes in his long-term prospects. Makes sense.
That's the key takeaway here. Even the Oracle of Omaha doesn't have a crystal ball. He's making calculated decisions based on his assessment of the current market and individual companies. And he's not afraid to change course if his assessment changes.
Which brings us back to that crucial point. We can't just blindly copy Buffett's moves. We need to understand the principles behind them and apply them to our own unique situations.
Couldn't agree more. Investing is a personal journey. What works for Warren Buffett with his billions and his decades of experience might not be the right approach for someone just starting out or with different financial goals.
So what's the biggest takeaway you hope our listeners walk away with today? Besides a craving for pizza, of course.
I'd say it's the importance of being an active, informed investor. Don't just blindly follow the crowd or chase the latest trends. Do your research, understand the businesses you're investing in, and be prepared to adapt as conditions change.
And never stop learning. The world of investing is constantly evolving. There's always something new to discover. Maybe it's a new sector, a new company, or even a new way of thinking about risk and reward.
Exactly. Keep your eyes open, your mind curious, and your portfolio balanced. And who knows, maybe one day we'll be analyzing your brilliant investment moves on this show.
Now that's an ambition worth striving for. But for now, we'll keep diving deep into the world of finance and investing, sharing what we learn along the way. Thanks for joining us on this fascinating journey into Warren Buffett's latest moves.
It's been a pleasure. Until next time, happy investing, everyone.
And keep those thinking caps on.